Here's something that catches almost every retiree off guard: the government can tax your Social Security. The same benefit you paid into your whole working life, and depending on your income, up to 85% of it can be hit with federal income tax. Most people have no idea until they file and see the bill. So in the next few minutes I'll show you exactly how it works, the simple formula that decides whether your benefits are taxed, the income lines where 50% and then 85% become taxable, the sneaky reason more retirees get taxed every single year, and the moves that can legally shrink that tax. Plain English, real numbers. Quick and important: I'm not a CPA, an attorney, or a financial advisor, and this is education, not advice. Tax situations are personal, so confirm yours with a tax professional or at irs.gov and ssa.gov. First, the basic truth: Social Security is not automatically tax-free. Whether any of it gets taxed depends on your total income. Some retirees pay zero tax on their benefits. Others have up to 85% of their benefit counted as taxable income. The difference comes down to one number the IRS calculates, and it's not the number you'd expect. That number is called your provisional income, sometimes called combined income. And here's the formula, in plain terms. Take your adjusted gross income, things like pension, IRA withdrawals, wages, investment income. Add any tax-exempt interest. Then add half of your Social Security benefit. That total is your provisional income. Notice what that means: it's not just your Social Security that decides the tax, it's everything else stacked with it. A big IRA withdrawal or a poorly timed investment sale can push your provisional income up and drag your Social Security into being taxed. That's the key that unlocks everything else. Now the actual lines. For 2026, here's where it kicks in. If you're single, below about $25,000 of provisional income, none of your Social Security is taxed. Between $25,000 and $34,000, up to 50% of your benefit becomes taxable. Above $34,000, up to 85% can be taxed. If you're married filing jointly, the same structure applies with higher lines, $32,000 and $44,000. One thing to be clear about: being 85% taxable doesn't mean you lose 85% of your check. It means up to 85% of your benefit gets added to your taxable income, then taxed at your regular rate. Still, for a lot of retirees, that's a real and surprising bite. Here's the part that quietly gets worse every year, and almost no one explains it. Those thresholds, the $25,000, the $34,000, the $32,000, the $44,000, have basically never been adjusted for inflation. They were set decades ago and frozen. But your income and your COLA raises keep going up. So every year, as benefits rise and incomes drift up, more and more retirees cross those old, frozen lines and start owing tax on their Social Security, even though nothing about their real spending power changed. It's a hidden tax increase that happens automatically, just by standing still. Knowing it exists is the first step to planning around it. Here's the good news: since the tax is driven by your other income, you have real levers. Roth accounts are the big one. Money you pull from a Roth doesn't count in that provisional income formula, so it doesn't push your Social Security into being taxed. That's why converting some savings to Roth in your lower income years can pay off for the rest of retirement. Timing matters too. Spreading out big IRA withdrawals instead of taking one huge one in a single year can keep you under those thresholds. So can being thoughtful about when you sell investments. You can't change the frozen thresholds, but you can control the income you stack against them. Quick but important: that was federal tax. What about your state? Good news for most people: the large majority of states do not tax Social Security at all. As of 2026, only a handful still may partially tax benefits: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont, and even those have their own income limits and exemptions. West Virginia just finished phasing its tax out. So unless you live in one of those states, your Social Security is likely safe at the state level, but check your own state's rules. So here's your plan. 3 steps. Step 1. Estimate your provisional income, your other income, plus tax-exempt interest, plus half your Social Security, and see which side of the threshold you're on. Step 2. If you're near a line, look at where your income comes from. Roth withdrawals and spreading out IRA distributions can keep more of your benefit tax-free. Step 3. Because this is where real dollars hide, sit down with a tax professional before a big withdrawal or a Roth conversion. The right move in a low-income year can save you for years. The tax on Social Security is frustrating, but it's not random. It's driven by numbers you can see coming and often plan around. If this cleared up how Social Security gets taxed, hit subscribe. One clear retirement money breakdown every week, plain English, no hype. And tell me in the comments, were you surprised they can tax your Social Security? Next time, the best age to claim Social Security, 62, 67, or 70, and the break-even number that decides it. I'm Ray. Take care of your money, and take care of each other.